I've read the term of all 14 Bitcoin-denominated convertibles. No sugarcoating, no half-reading, no bias. And I come to the same conclusion every time, that Bitcoin-denominated convertibles are actually just a discounted share issue. So in this episode, we are going to talk about what a Bitcoin-denominated convertible is, and we're going to go over 3 different examples of companies that have issued this. Capital B, Smarter Web, and Connecting Excellence Group. A convertible bond is really 2 different structures merged into the same instrument. So it has the liability and then it has the embedded option. And for a Bitcoin-denominated convertible, the liability is in Bitcoin terms, and this has some very interesting implications. So for a normal convertible and for the Bitcoin-denominated ones, there are really 2 different scenarios. Either the convertible matures and you pay back the liability, and for Bitcoin-denominated convertibles, where the Bitcoin treasury simply holds the Bitcoin on the balance sheet, it's that they pay back the Bitcoins. So if it's a 10 Bitcoin, if the principal is 10 Bitcoins, they simply pay back the 10 Bitcoins. So it's a net zero game. And the other scenario of a convertible is that it converts. And usually, or always, these Bitcoin-denominated convertibles of course have a conversion price, and then they have a forced conversion price above the conversion price. So by the time the share price exceeds the forced conversion price, the actual conversion price will be at a discount to the share price. So that's what I mean, that a Bitcoin-denominated convertible is like a discounted share issue disguised as a bond. Either the company pays back the Bitcoin principal or they issue shares at a discount, because the forced conversion is at a premium to the conversion price. So we are gonna look at a few different examples of this. 3 different companies that have issued Bitcoin-denominated convertibles. It's Capital B, Smarter Web Company, and Connecting Excellence Group. Starting with Capital B, their forced conversion term is that on or after the 3rd anniversary of issuance, the issuer may convert if the volume-weighted average price over 20 consecutive trading days is above 130% of conversion price. So this means that if the Bitcoin-denominated convertible converts for Capital B, it will convert at a 23% discount when the share price is at the forced conversion limit. And Capital B has issued 130 million euros of their B series, which is the Bitcoin-denominated convertibles, and this is 87% of all their issued debt. So Bitcoin-denominated convertibles play a major role in Capital B's strategy. And when you look at these terms, it's really that they're just issuing shares at a discount. There is no other way to describe it, because the Bitcoin that they're holding, that they get from these convertibles, they're not using them productively, let's say, although they might be used as collateral, although it's a liability, so you can't really use it as collateral. So they're just holding the Bitcoin on the balance sheet, and then they pay it back if it doesn't convert. Moving over to Smarter Web Company, their forced conversion term is after the initial 6-month period, the company may force conversion into equity if the share price trades 50% above conversion price for 10 trading days. So this represents a discount of 33%. So either they pay back the principal of 178 Bitcoin, or they issue shares at a 33% discount. And moving over to Connecting Excellence Group, this convertible bond has one additional term that the 2 other ones don't have, and I'm gonna get to that. But the forced conversion is a compulsory conversion if the volume-weighted average price exceeds 120% of conversion price for 10 consecutive trading days. So 120% of the conversion price, that's a discount of 16.7%. So either they pay back the principal of 10 Bitcoins, or they issue shares at a 16.7% discount. And the extra term that Connecting Excellence Group introduced into this bond is a Bitcoin adjusted conversion price. So if Bitcoin doubles, then the conversion price also doubles. But this doesn't solve the underlying issue, because the shares will only convert at a premium to the conversion price, so they're still issuing shares at a discount. And the only other alternative is that they redeem the Bitcoin, they pay back the Bitcoin. So either pay back the Bitcoin, net zero game, or they issue shares at a discount. So now we have went over these three companies, and you have hopefully learned a little bit about Bitcoin-denominated convertibles. And saying that, it's very important to actually look at these companies' capital stacks to really understand how they work, because it's not always as advertised. And in the next episode, I'm gonna talk about Death Spiral convertibles issued by Matador, DDC Enterprise, and Line Group, which are arguably much worse than Bitcoin-denominated ones. But I think this is a very important series if you're interested in Bitcoin treasuries and want to understand this space. So see you in the next episode.